Welcome to the Deep Dive. We grab a bunch of interesting sources and, well, pull out the key takeaways for you.
Think of it as the fast track to getting up to speed.
Exactly. We know you're curious, you want to grasp things quickly, get those aha moments, but,
Yeah.
Without feeling totally overwhelmed.
And for this deep dive, we're jumping into something maybe a little unexpected.
Yeah.
The surprising link between physics, math, and, believe it or not, the world of finance. We're drawing on sources like James Owen Weatherall's book, The Physics of Wall Street.
Okay, physics and finance. I admit that's not the first connection most people would make.
Right. It does sound a bit odd.
And that's kind of the mystery we want to explore today. Because, actually, some of the biggest wins on Wall Street didn't come from finance folks at all.
James Simons is probably the perfect example here. Renaissance technologies.
Ah, yes. The legendary medallion fund.
Exactly. Now, Simons himself, he's a mathematician, a physicist. He even co-created something called the Chern-Simons 3-form.
Which sounds incredibly complex.
No.
Like fundamental physics stuff?
Oh, absolutely. Deep theoretical physics. Puts him among the world's top physicists, actually. Far cry from trading desks.
And this is the guy who founded one of the most successful hedge funds ever.
That's the one. Renaissance Technologies. And the returns for their medallion fund, just unbelievable. Way beyond what legends like Soros or even Buffett achieved.
Wow. And wasn't there something about his appearance? Not exactly the Wall Street stereotype.
Yeah. Apparently, he's often in a t-shirt, rarely wears socks, sort of the opposite image you'd expect.
That's quite the contrast.
And it gets better. Renaissance mostly hires scientists, physicists, mathematicians, statisticians, not MBAs.
Really? So they actively avoid the traditional finance types.
Seems that way. One mathematician even said it was like the best math and physics department in the world. The idea seems to be that this scientific thinking is the key, a totally different approach.
It does make you think, what is it about that scientific mindset, that focus on data, patterns? How does that work so well in finance, which seems so chaotic sometimes?
Like they're seeing signals others miss?
Yeah.
Well, the basic idea of managing risk isn't brand new. If you look way, way back.
How far back?
Mesopotamia, over 4,000 years ago, archaeologists found these clay tablets.
No kidding. What were they for?
Early futures contracts, essentially. Like Sumerian farmers agreeing on a price with a priestess for barley she'd need months later.
So, hedging. Locking in a price to avoid future uncertainty.
That's the core idea, yeah. Protecting against price swings.
Okay, so the concept's ancient, but what the quants are doing now is different.
Oh, completely different scale. These modern hedge funds, run by quants using quantitative analysis, they're sort of the new elite. Many have PhDs in physics, math, stats.
Right. They're all about the mathematical tools, the computer models.
Exactly. It's all about managing risk systematically, aiming for steady profits, using powerful computers and complex math, trying to iron out the bumps, you could say.
But then, August 2007 happened.
Ah, yes. August 6th, a Monday. The infamous quant quake, or quant crisis.
What exactly went down? I remember hearing about it, but the details are fuzzy.
Well, suddenly, all these sophisticated quant strategies, the ones designed to make money steadily regardless of which way the market went, they all started losing money. At the same time...
Wait, simultaneously? Across different assets?
Pretty much. Stocks, bonds, currencies, commodities... The standard models just broke down. Yeah. Assets that should have zigged, zagged, hedges failed. Billions were lost very quickly.
And the quants themselves were baffled.
Completely bewildered by most accounts. I mean, these are brilliant people. And adding to the weirdness, the overall market, like the Dow Jones, actually rose that day.
That is strange. So their specific strategies failed, while the broader market was okay.
For that day, yeah. Big funds took massive hits. Morgan Stanley's PDT fund, AQR, Goldman's Global Alpha, losses in the hundreds of millions, sometimes in a single day.
Ouch. The media must have jumped on that. The quant crisis.
They did. It reminded people of that old Isaac Newton quote, after he lost a fortune in the South Sea bubble.
Oh, the one about calculating heavenly bodies but not human madness?
That's the one. Seems fitting somehow.
So how did things play out for the rest of '07 for the quants?
It was mixed. Some funds clawed back some losses. Others didn't really recover that year. Average hedge fund returns were pretty mediocre.
But what about Simons? What about Renaissance?
Ah, good question. Here's the kicker. Medallion fund. They still ended 2007 up nearly 74%.
74%.
Yeah.
in that year, even after the August turmoil.
Yep, they felt the August hit too, apparently, but recovered spectacularly.
And then 2008 happened, the big one.
Right, the global financial crisis, banks collapsing, markets plunging,
And Medallion.
reported returns of around 80%.
80% in 2008.
Girl.
It's insane. While everyone else was imploding.
Pretty much. It really drives home the point that they must be doing something fundamentally different, using that physics and math background in a unique way.
Okay, so we need to dig into that. What is the physics in finance? Where did these ideas even come from?
Well, to get there, we need to talk about a guy named Louis Bachelier. A bit of a forgotten figure, maybe?
Bachelier. Tell me about him.
His story's pretty interesting. He was an orphan in Paris, late 1800s, had to work at the Paris Stock Exchange, the Bourse, to support his family, but he was also studying math and physics on the side.
Wow, juggling work and studies like that.
Yeah,
Tough.
definitely. But he got fascinated by probability theory, and he started looking at the market as basically a complex game of chance.
A game of chance.
Yeah, and in 1900, he writes his PhD thesis, Theory of Speculation. And in it, amazingly, are early versions of things like the Wiener process, a way to mathematically describe continuous random movement, like think Brownian motion, and also Kolmogorov's equation, another key tool in probability, stuff that's fundamental now.
So he developed these sophisticated ideas way back in 1900, applied to finance.
Exactly. Decades before others really picked up on it. Apparently, the famous economist Paul Samuelson found the thesis much later and was just blown away.
Yeah, so he's trying to make economics more mathematical, right?
Right. He was. He'd studied with E.B. Wilson, who was a student of J.W. Gibbs, the statistical thermodynamics guy. So Samuelson was trying to bring that kind of mathematical rigor from physics into economics.
And he finds Bachelier already did some of it.
Kind of beat him to the punch on some core financial math ideas, yeah.
So what was Bachelier's main insight? The game of chance idea.
His central idea was modeling price changes as a random walk. Like Brownian motion, pollen grain jiggling randomly in water, or think of a drunkard stumbling randomly left or right.
Okay. Like our friend in Cancun, maybe.
Yeah, maybe. The point is, each step is random. Bachelier said stock prices are like that. At any moment, roughly a 50-50 chance of going up or down slightly.
So unpredictable in the short term.
Basically, yes. But he also used the normal distribution curve, the bell curve, to figure out the probability of a price reaching a certain level over time.
All right, the bell curve. Most likely outcome is near the start, less likely to see big jumps either way.
Precisely. And this connects to an early version of the efficient market hypothesis,
Which says,
that current prices reflect all known information. So, unless new info comes along, future moves are random. You can't consistently predict them based on past prices alone. Eugene Fama formalized it much later, but Bachelier had the seed of the idea.
like trying to predict coin flips. If the coin's fair, past results don't help.
Exactly, a fair game. And Bachelier even tried to use this to price options.
Options, okay, refresh me quickly. A call option is?
The right, but not the obligation, to buy an asset like a stock at a set price, the strike price, before a certain date.
Got it. So Bachelier tried to calculate a fair price for that right.
Yes, using his random walk model. He figured out the probability of the stock price ending up above the strike price by expiration. That probability helped determine the option's theoretical fair value.
Did that part catch on?
Not really, not initially. His random walk idea got more traction later, but the option pricing model was kind of overlooked for a long time.
Fascinating. A real pioneer, but maybe too ahead of his time.
Seems that way. But the ideas didn't die out completely. There was a sort of second wave building on this foundation.
Okay, who's next?
A physicist named Maurice Osborne. Maury Osborne.
Osborne. What did he do?
He worked at the Naval Research Lab, and in 1959 he published this really key paper, Brownian Motion in the Stock Market.
Another Brownian motion link. So building directly on Bachelier.
Well, acknowledging Bachelier came later.
Yeah.
But yes, similar ideas, though Osborne had a very different research environment. Post-WWII America was a different scene.
How so?
There was this new culture emerging, especially after things like the invention of nylon or, more significantly, the Manhattan Project.
Right, the atomic bomb project. Huge scientific effort.
Huge and incredibly collaborative. It brought together scientists, engineers, industry, breaking down old disciplinary silos. Think about Einstein writing to Roosevelt about the bomb's potential.
The urgency must have been immense.
It was. And you had companies like DuPont, famous for nylon, applying their industrial scale-up know-how to producing plutonium, something the physicists initially doubted could be done on that scale. It fostered this environment where theoretical insights and practical applications went hand in hand.
So Osborne was working in that kind of cross-disciplinary, application-focused environment.
Yeah, much more supportive than what Batchelor likely faced.
Yeah.
Osborne approached the stock market data, stuff from the Wall Street Journal, almost like an outsider, like, say, an astronomer analyzing stellar data.
A fresh perspective.
Exactly. And he made a key correction or refinement to Batchelor's model.
Oh, what was that?
Instead of assuming stock prices follow a normal distribution, Osborne argued it's the logarithm of the price, or more intuitively, the percentage returns, that follow a normal distribution. So log normal for prices, normal for returns.
Okay, why does that matter? Log normal versus normal prices.
Well, think about it. If a $10 stock goes up $1, that's a 10% gain. If a $100 stock goes up $1, that's only a 1% gain.
Right, the percentage change is different. That feels more important to an investor.
Precisely. Osborne connected this to something called the Weber-Fechner law in psychology.
Psychology, how does that fit in?
It suggests our perception of a change is relative to the starting point. A 10% gain feels like a 10% gain, whether the stock started at $10 or $100. So modeling the percentage returns, which follow a normal distribution if prices are log normal, captures investor perception better.
That makes sense. And log normal also means prices can't go below zero, which is obviously true for stocks.
That's another crucial advantage, yes. It fits reality better than a simple normal distribution for prices.
So he brought in statistics, physics analogies, even psychology, a real interdisciplinary approach.
Definitely. And he was apparently quite an independent thinker, too. Weatherall mentions him debating Einstein on dark matter.
Wow, okay. Didn't pull any punches.
Seems not. He published his stock market paper in an operations research journal, not finance, initially faced some criticism about whether it was truly original.
The Batchelor issue again?
Yeah. But Osborne followed up, acknowledged Batchelor, but also provided strong empirical evidence from market data supporting his log normal model. That got his work included in Paul Kuttner's influential collection on the random walk theory.
So his contribution was recognized eventually.
Yes. And interestingly, Osborne also did research on salmon migration.
Salmon. What's the connection?
He analyzed how they navigate, looking at different time scales, the fast short-term fluctuations in water currents, and the overall long-term path upstream.
Okay. Analyzing things on different time horizons.
Exactly. Which hints at analyzing market behavior the same way short-term noise versus long-term trends, a concept that's become really important in modern finance.
Seeing similar patterns in fish in finance. That's wild.
It shows how these fundamental ideas about complex systems, randomness, and scaling can apply across fields. Though, interestingly, Weatherall notes that even with this kind of work, when Osborne later went for a PhD, his finance-related thesis was initially rejected.
Still hitting those academic silos, huh? Even after the wartime collaborations.
Seems old habits die hard sometimes.
So, quite a journey we've taken. From theoretical physics concepts and early probability theory,
Through Batchelor's lonely insights at the Paris Bourse,
to Osborne applying physics thinking and even psychology at the Naval Research Lab.
all leading towards this quantitative revolution in finance, exemplified by people like James Simons.
And hopefully, for everyone listening, it's a bit clearer now why physicists and mathematicians ended up having such a massive impact on Wall Street. It wasn't just number crunching.
No, it was a fundamentally different way of thinking about risk, uncertainty, and patterns, using tools developed for understanding the physical world, applying randomness and statistical analysis in totally new ways.
It gives you that aha moment, seeing how these abstract ideas became practical, powerful tools in finance.
Yeah, it's quite something. Which leads us maybe to a final thought to leave with our listeners.
Go for it.
Well, we've seen how powerful these mathematical models can be, but we also saw the 2007 quant crisis where the models stumbled. Have we fully learned those lessons? Are we constantly questioning the assumptions behind the models, their limitations? Renaissance technology seems to thrive, maybe because they do constantly question and adapt their models in ways others don't.
So the models are tools, not crystal balls.
Exactly. And it makes you wonder what other fields, seemingly unrelated today, might hold the keys to the next big breakthroughs in understanding complex systems like markets. Where will the next Batchelor or Osborne come from?
That's definitely something to chew on. Food for thought after this deep dive.